Hi there, welcome to Kneppy Invest. Continuing in my financial year 23 result video series. This episode, we'll be looking at a company called Coventry Group, ticker code CYG. I'd say most people don't know much about this company, even though it has been a listed entity for almost 60 years. So this company has been around for a long time. It has gone through cycles. It has changed a fair bit over those 60 years. Even the last 10 years, this company has changed a fair bit. But it does look like right now it is going through a bit of a growth spurt. So before we have a look at the company's financial year 23 results, let's talk a little bit more about what this company does. Coventry Group was actually founded in 1929 by Ronald James Kyle when he acquired a car dealership from a liquidator, and Coventry Motor Replacements was born. Not sure why he called it Coventry Motor Replacements. Maybe he was a fan of the Coventry football team, or maybe his parents came for Coventry, or maybe he himself came for Coventry. A lot of times when a new business is formed, usually the founder implements their own name. So this could have been Kyle Group or James Kyle Group, or maybe initials RJK Group, but no, Coventry Group was formed as a motor replacement business or a car dealership back in 1929. And as I mentioned, it listed on the ASX in 1966. Now, this company comprises of two distinct businesses or divisions: Fluid Systems and Trade Distribution. Fluid Systems designs, manufactures, and sells hydraulic, lubrication, fluid transfer, refueling, fire suppression, automation systems, and products. Now, Fluid System has a capability to design, manufacture, install, maintain, and supply full turnkey solutions and components through a network of 15 branches in Australia. Trade Distribution comprises of Connect and Arteria Australia, KAA, Connect and Arteria New Zealand, KANZ, and Nubco supply a range of fastening systems, cabinet hardware systems, industrial and construction products through a network of 48 branches in Australia and 17 branches in New Zealand. Now, to be honest, what they do, I have no use of. So this company actually does service the mining industry and stuff like that. Some of their brands include Cooper Fluid Systems, Torque Industries, HIS Hose, Fluid Power Services, Nubco, Connect Fastening Systems, and a few others as well. Now to the financial year 23 results for this company. Revenue of $358.5 million, which was 11.2% higher than the previous corresponding period or financial year 22. Now, you can just see by comparing the profit to the revenue, this company, well, at least in financial year 23, existed on fairly low margins. Profit of only $2.5 million, and there was a bit of a margin squeeze. So even though revenue went up, profit actually went down by about 50%. Gross margins at 39.9%. And even though it was only profit, or this company only produced profit of $2.5 million, operating cash flow and free cash flow were between $15.4 million and $19.1 million. And the main reason, typically in these sort of situations, why there is a discrepancy between profit and operating cash flow, free cash flow, is because of depreciation and amortization. Some companies will report EBITDA, and typically EBITDA is going to be more closely aligned with free cash flow or operating cash flow than profit. A company also has a little bit of net debt, $33.6 million, which is okay. I prefer companies to have as little debt as possible, but a little bit of debt is not that bad. Some people or some investors will compare the debt to, say, equity and look at debt to equity, that sort of thing. And typically, some investors don't want to see debt to equity get any higher than, say, 0.8 or 0.75. Definitely not higher than 1. And at this point, Coventry Group has a debt to equity of less than 1. 95.3 million shares on issue and a share price of $1.47. I looked at that on a Wednesday, the 17th of January at about 3 p.m. local time. So just before trading had finished for the day. And that means the market cap of this company is around 140 million. So if you understand this company has been on the ASX for almost 60 years, this company has not grown much over that 60-year period. So this is definitely not a growth company. However, there have been times during that 60-year period where this company has gone through a bit of a growth spurt. And I think right now, as I mentioned earlier, we are seeing one of those times in the history of this company. $113 million of equity. Now, if you view a company's quality based off its return on equity or return on invested capital, return on capital, return on assets, you'll probably say this company is not high quality because return on equity 2.2, return on invested capital 1.4. But I will say that the profit of this company can fluctuate quite widely from year to year. But overall, if you look at the last 10 years, this company does have typically a fairly low return on equity and return on invested capital. Company does issue a dividend to the shareholders, and currently the dividend yield of Coventry Group is an okay 2.5%. Well, that's okay if a company is not really growing or is not a growth company. I should say a dividend yield of 2.5% is okay if a company is a growth company and they are able to increase the dividend over the next 10 to 20 years. Probably can't say that in regards to Coventry Group because who knows how this company is going to perform in the next 5 to 10 years. They could cut the dividend, or this company could grow a significant amount and the dividend could be significantly higher than it is now. Just don't know because this company has had an extensive history on the ASX and it hasn't really succeeded in its business plans over that period of time. But maybe now's different. Maybe this time is different. Maybe this growth spurt the company is undergoing can continue for a while yet. Always like to see a breakdown of revenue, EBITDA, profit into different segments or divisions of the company. So they've done that in one of their presentations, their financial year 23 presentation. They've divided their revenue and the EBITDA of the company into their different divisions. So fluid systems, $148.1 million of revenue, trade distribution, $210.1 million. And if you just compare the EBITDA to the revenue, by far the more efficient division is fluid systems with EBITDA of 15.3 million. EBITDA of trade distribution is 17 million. You notice here they did not include profit. And the main reason is because this company does have a fair bit of depreciation amortization. So the difference between EBITDA and profit is significant. So we're talking about 32.3 million compared to 2 million. And most of that is because of depreciation amortization. Some of that is because of interest. And of course, some of that difference is because of taxation. Now let's have a look at the valuation metrics for Coventry Group. Now you probably could ignore P/E ratio, 57.2. That does seem excessively high, but I am a little bit dubious that a profit of 2.3 million is a good guide to how this company is performing financially. I probably would prefer to compare or look at some of the operating cash flow, free cash flow metrics, and I have done that with EV to operating cash flow, which is at a nice 9.3. So it's in my range of 6 to 10 in determining whether a company might be good value, fair value, or overvalued. So if I do see EV to operating cash flow between 6 and 10, either fair valued or maybe trending towards good value. So maybe Coventry Group, just based off the operating cash flow and the EV, is good value right now, or at least fair value. Price to book ratio, 1.26. So it's trading just above book value. Free cash flow yield, 11.6%. That's another thing I am looking at more often these days is the free cash flow yield, just because of research I have read that does show that free cash flow yield of a company is a good predictor of whether a company is going to outperform the market or not. So the higher the free cash flow yield is better predictor of a company's future success in beating the market. So 11.6% free cash flow yield is actually quite nice. Also did a reverse DCF based off the free cash flow, just to see if or what growth this company has to achieve in free cash flow to justify the current valuation. Not much growth at all, only 0.66%. So in a way, the market is saying we don't really think this company can grow their free cash flow much over the past or over the next 10 years. And if the company can, again, there is an argument to say that Coventry Group might be fairly good value, even cheap right now. Now into the financial history of this company, first focusing on revenue and gross margins. I'll just ignore the gross margins for now and just focus on the total revenue. And I've already mentioned this company is going through a bit of a growth spurt right now. That growth spurt started in 2017, 2018. Before that, revenue was dropping. In fact, between 2014 and 2017, revenue dropped from 206 million to 151 million. I actually also read somewhere, I think it was on their website, that at one point, maybe a couple of decades ago, this company had over 500 million of revenue. So I've already mentioned that this company has gone through some difficult times. And definitely when a company's revenue drops from 500 million to 150 million, that is a period that can definitely be called a bad period. So definitely a bad period, but things have turned around over the past 7 years. In fact, revenue has more than doubled from 150 million to 358 million over the past 7 years. Not only that, gross margins have also increased. So the low point in gross margins was in 2018 at 37%. Now we're talking about 40% gross margins, or just below 40%. So that's actually a thing to like, to see revenue increasing, gross margins increasing. The only thing I like to see now is profit increasing alongside both of these particular metrics. And talking about profits, I've included that particular metric in this particular slide alongside cash flow from operations. So we're seeing the growth in revenue over the past 7 years. We're seeing growth in gross margins. What I want to see now is growth in profit and growth in operating cash flow. And you probably could argue we're definitely seeing that, because back in 2017, this company was unprofitable, loss of $5 million, actually $36 million, and operating cash flow negative by $5 million. So more than likely, the reason this company was unprofitable by 36 million was because of some one-offs, some decreases in the value of their goodwill or something like that. And then we have seen profit and cash flow increase over the past 7 years. And in fact, all two have been positive over the past 3 years. And cash flow from operations have been positive over the last 4 years. But I would like to see profit increasing. It has been quite variable over the last 6 years. In fact, it went from being a 5.65 positive in 2018 to positive 7.3 million in 2021, but it has decreased the last 3 or 2 years. So I'd like to see profit increasing alongside the increase in operating cash flow, increase in revenue, and an increase in gross margins. One thing I always like to look at is an understanding of why a company's profit can be quite different than the company's operating cash flow, or even EBITDA, something like that. And you will always, almost always, find this explanation in the notes. And for Coventry Group, it's found in note 25, called Reconciliation of Cash Flows from Operating Activity. So what they do is they start at the profit for the period, make all these adjustments, and then finish at the cash flow from operations. So you go from profit of $2.5 million and finish with the net cash flow from operations of $19.1 million. Now, I did surmise that the most likely reason behind this discrepancy, or this difference between these two numbers, is depreciation, amortization. Sometimes it's because of changes in working capital. A company has significantly increased inventories, for example, but for Coventry Group, it's all about depreciation and amortization, $16.4 million. And that almost completely explains the difference between profit and operating cash flow. The next question I had when it comes to depreciation and amortization is why, in my opinion, that number is quite high for this company. Usually you find depreciation and amortization high for companies that are capital intensive. I did not think, or would not think, Coventry Group would be necessarily highly capital intensive. Now, if you could find information in section 14 or note 14 after the financial statements, which is right of use assets, and they separate the right of use assets into property and vehicle. So this is the reason why. So $8.9 million depreciation of property, $3.9 million of depreciation for vehicles. So they seem to have a lot of vehicles. And it seems like this is a similar thing from year to year. I think it has something to do with leases, their property. So they have a carrying amount at the 1st of July 2022, $37.2 million, additions $9 million, termination of the leases $391,000, lease reassessments $7.4 million, and depreciation for the period $8.9 million. So something to do with leases. They also have effective movements in foreign exchange. And I think the vehicles is self-explanatory. They have a few vehicles, apparently, quite a few vehicles, and they had to adjust the value of those vehicles by $3.9 million in financial year 23. One thing I like to look at for a lot of companies is just the markup history. Just how has the markup of this company, or the valuation of this company, changed over time? And it's really interesting to look at companies that have been listed for a long time. to see how the market viewed this company in the past. So this is the market cap history of Coventry Group going back to 1998. So we're talking about 25 years of history here. And what you see here in terms of market cap is definitely not a high quality company. So if you look at a high quality company, the market cap should be increasing through time. That's exactly what you want to see for a company that's in your portfolio for the long term. Market cap increasing through time. And currently, the Coventry Group market cap is actually lower than it was back in 1998. In fact, the valuation high for this company was in 2005 when the market cap reached a high of 280 million, while the market cap low was back in 2017. Remember that period between 2014 and 17 when the revenue of this company was dropping. The market was concerned, seriously concerned during that period, because the market cap of this company fell from $130 million down to $20 million. Yes, you could have bought this company completely back in 2017 for $20 million. But since then, things have turned around. Revenue started to increase. We'd like to see that increase in profit, but at least the company is profitable. Company is operating cash flow, free cash flow positive. And that's why the market cap is now significantly higher than it was in 2017. In fact, it's gone from $20 million to $140 million, but still half of what it was back in 2005, when again, the market cap of this company was $280 million. So definitely not a high quality company just by looking at the market cap history over the past 25 years. Quite conveniently, the company did release a trading update on the 16th of January, one day before I recorded this video. So they have given a bit of an update to how the two segments or divisions are performing in terms of revenue and overall group EBITDA. Things are moving in the right direction for the company when you look at these numbers compared to the previous corresponding period. So trade distribution revenue has increased 2.2% from the previous corresponding period, but fluid systems revenue has increased 10% from the previous corresponding period. So overall group revenue increased 5.4%, while group unaudited EBITDA has increased 18.1%, which probably suggests some of the margins of this company have improved over the past year. Now, they've also compared, well, actually, they didn't compare it, but they've given us the first quarter numbers of financial year 24 and the second quarter numbers of financial year 24. And it seems like trade distribution is going through some pains right now. In fact, revenue dropped $5 million from the first quarter to the second quarter. However, fluid systems keeps on improving. Revenue up $1.2 million comparing quarter to quarter. Looking at the commentary, some positives, some negatives, depending on where you are. So demand remains robust in our primary end markets in Australia, mining and resources, infrastructure, commercial construction, and industrial. But it seems like New Zealand is doing it tough. The New Zealand economy has weakened due to the recessionary environment, and this is having a short-term negative impact on our Connect and Atia New Zealand operations. Overall, the whole group combined, not just New Zealand, overall, our strategy based on specialization and service excellence is continuing to be resilient. Now let's have a look at the chart, the weekly chart for Coventry Group. This goes back to the start of 2014. And remember, revenue between 2014 and 17 dropped like a rock, and the share price dropped like the rock. So sometimes the financial performance can drive the share price. So if a company improves financially, share price should likewise improve go up. And if a company's financials go down, more than likely the share price will go down. It all works. I did listen to Ausbiz The Call, an episode a few weeks ago, and there was a little bit of fight between the two. Not a fight, a banter between the two. I forget who it was. Because one said the share price of the companies do not follow the financial performance, which is ridiculous. The other person sort of disagreed. But I think it is absolutely true that over time, the share price, the valuation of a company will follow the financial performance. You can see that just with Coventry Group in this 10-year period. So the share price of Coventry Group the middle of 2014 reached a high of $3.10 and then fell all the way down to 50 cents. In 2017. So over a 3-year period, the share price of this company dropped from $3.10 to 50 cents. And then things started to turn around. The share price hit a low of 50 cents again during the COVID-19 financial panic. But things are starting to turn around, particularly if you look at the weekly chart. That downward period, that downtrend period between 2014 and 2017, definitely coming to an end. And if you just look at the daily chart, the share price now is in an uptrend. So it's sort of a medium-term uptrend. And if you look at the weekly chart here, definitely the share price is trending up. From the lows we saw about 1 year ago, share price reached a low of about 87 cents. And the main reason I think the share price is starting to move into an uptrend is because the company have released a few positive financial reports and trading updates. Still quite a few companies to get through to complete this particular financial year 23 result series. The next 5 companies I'll be looking at include Maggie Beer. Really looking forward to that because I've not had a look at Maggie Beer before. Share price has been in a well-defined downtrend for about 2 years. And maybe I'll see something in their financial results to think there might be some good value in the company. Who knows? Reject Shop, ResMed, Calix, and then Sonic Healthcare. And that is all I have for this look at Coventry Group's financial year 23 results. If you have any thoughts, any suggestions, any questions, just leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.